Navigating the world of real estate can often feel like deciphering a complex code, thanks to the myriad of industry-specific terms and phrases. It's easy to get lost in the jargon, but fear not. Whether you're in the market to buy your dream home or looking to make a smart sale, we've crafted this video to be your guiding light through the linguistic labyrinth. Our mission? To demystify the real estate lexicon and empower you with the knowledge you need to confidently embark on your property journey. Inside, you'll find an ever-expanding compendium of 50 essential real estate terms. These are the keys to unraveling the intricacies of the real estate world, helping you make informed decisions and plan your next move. So, without further ado, let's dive into the terminology that will unlock the doors to your real estate success. Adjustable rate mortgage, ARM. Now, let's explore the intriguing world of adjustable rate mortgages, often referred to as ARMs. These financial instruments bring an element of fluidity to your mortgage experience, making them worth your attention. With ARMs, the game changer is the fluctuating interest rates. Initially, you might enjoy a fixed rate period, offering stability in the unpredictable sea of real estate finance. But hold on, because here's where the excitement begins. These interest rates have a chameleon-like quality. They shift in response to a designated interest rate index, which could be the likes of LIBOR or COFI. Why consider an ARM, you ask? Well, for one, it's the potential for lower interest rates during specific timeframes. It's a gamble, but one that savvy investors often take. In this video, we'll delve deeper into the intricacies of adjustable rate mortgages, so you can decide whether they're the right choice for your real estate endeavors. Before we proceed, if you're finding this information valuable and want to stay in the know with more engaging content like this, don't forget to hit that subscribe button below. We've got a lot more to share on real estate investments and beyond. Appraisal. When it comes to assessing the value of a piece of real estate, an appraisal is the pivotal player. In the context of a home sale, the mortgage lender dispatches an appraiser to provide a professional evaluation of the property's worth. This evaluation is crucial in helping the lender determine if the property aligns with the loan amount sought by the potential buyer. Appraisal contingency. Here, we introduce you to the appraisal contingency, a safeguard for the buyer. It's essentially a clause that grants the buyer the option to back out of a purchase agreement if the appraised value of the property falls short of the sale price. An appraiser, typically hired by the buyer's lender, ensures that the loan is supported by an accurate home value. Lenders use this measure to prevent overpaying for a property. As is. Now, we encounter the as-is condition, a phrase that carries significant weight in real estate. When a property is listed in as-is condition, it signifies that the seller is reluctant to undertake most, if not all, repairs. Alternatively, it may be priced as is, usually reflecting a value below the market norm in the area. It's crucial to note that the as-is condition is determined at the time the offer is made. Any subsequent changes to the property's condition, before closing, may require restoration to its original as-is state at the seller's expense, or a release of the buyer from their obligation, with a refund of expenses like earnest money. Backup offer. In a scenario where a property is already under contract with another buyer, the interested party can submit a backup offer. This offer remains contingent upon negotiation and the submission of monies such as earnest money to secure its place as the next offer in line. Legally, only one backup offer is permitted, as having a backup to the backup is not an option. Blind offer. For those in fast-paced and competitive markets, a blind offer may come into play. This term refers to an offer made on a property that the buyer has not physically seen, even if they had the opportunity to do so. It's a strategic move to secure a property quickly, often in high-demand circumstances. Buyer's agent, listing agent. In the real estate arena, two key players are at the forefront: the buyer's agent and the listing agent. The buyer's agent, also known as the selling agent, is a licensed professional responsible for locating the ideal property for the buyer. They diligently negotiate to secure the best price and purchase terms for their client. This agent operates as a fiduciary on behalf of the buyer. On the flip side, the listing agent, also referred to as the seller's agent, plays a different role. Their primary task is to market the seller's property and advocate for the seller's best interests. Negotiating on behalf of the seller, they strive to achieve the highest price and the most favorable selling conditions possible. The listing agent acts as a fiduciary for the seller. Covenants, conditions and restrictions, CC&Rs, often referred to as CC&Rs, these are a set of regulations governing real property. They are typically imposed by entities such as homeowners associations, HOAs, neighborhood associations, developers, or builders. These guidelines establish the requirements and limitations on what a homeowner can or cannot do with their property. Additionally, CC&Rs may entail monthly or annual fees, as well as special assessments. Conventional sale. A conventional sale is a straightforward transaction in which the property is either owned outright, with no remaining mortgage, or the owner owes less on their mortgage than the market suggests the property's value. These sales typically proceed with more ease compared to non-conventional transactions, such as foreclosures, probate-related sales, and short sales. Closing. The culmination of the real estate journey, closing marks the final stage of a home sale. It involves the completion of all necessary documentation, the transfer of funds, and, when a lender is involved, obtaining full approval from the lender. In certain regions, the act of recording the deed with the county clerk's office represents the ultimate step in closing. Once all these elements fall into place, the buyer gains access to the property, and they officially become the new homeowner. Closing costs. Closing costs encompass a range of fees associated with the closing of a real estate transaction. These fees can originate from various sources, including the lender, title company, attorneys, insurance providers, taxing authorities, homeowners associations, real estate agents, and other entities involved in the closing process. Typically, these costs are settled at the time of closing. Debt-to-income ratio, DTI. The debt-to-income ratio, or DTI, is a crucial number assessed by mortgage lenders. It's calculated by adding up all your debt expenses and your monthly housing payment, dividing this sum by your gross monthly income, and then multiplying it by 100. This ratio plays a pivotal role in helping lenders determine your affordability within their available loan programs. It's a barometer of how much you can comfortably allocate each month to your mortgage payments. Lenders typically look for borrowers who dedicate 28% or less of their total monthly income to housing costs and keep their debt payments to less than 36% of their income, as per Investopedia. If these percentages lean toward the higher end and you're aspiring to buy a home, it may necessitate a reevaluation of your budget. Due diligence. The due diligence period is a significant phase in the home buying process. It's often included in the purchase agreement and grants the buyer a specified timeframe to thoroughly inspect the property. This period might involve hiring experts to assess the property, conduct tests, and more, all to provide the buyer with comprehensive information to make informed decisions. It may also offer the opportunity to renegotiate the contract based on findings or, in some cases, terminate the agreement without being in breach. Essentially, due diligence empowers the buyer to gain a full understanding of their prospective purchase. Earnest money deposit, EMD. The earnest money deposit, also known as a good faith deposit, is the initial sum of money that a buyer is required to put down once the seller accepts their offer. It serves as both an indicator of the buyer's genuine intent to purchase and a demonstration of their commitment. The amount of the EMD can vary, typically ranging from 1 to 5% of the sales price. This deposit is often held by an escrow company, following the terms laid out in the Purchase and Sale Agreement, PSA. Escrow holder. The escrow holder is a neutral third party who acts as the agent and custodian of various financial and legal elements related to a real estate transaction. This entity collects funds, documents, personal property, and other valuables, safeguarding them until specific events or conditions are met. The instructions for handling these elements are typically outlined in a written agreement between the involved parties. Equity. Equity is a valuable asset for homeowners. It represents the investment a homeowner has in their property. To calculate equity, you subtract the total mortgages or liens on the property from the market value of the home. The remaining amount signifies the equity you hold in your home. If you purchase a home for $250,000 and it's valued at $260,000, you gain instant equity of $10,000. This asset can be leveraged to secure loans for various purposes, from home repairs to paying off higher interest debts. FHA loans. FHA loans are a part of a select group of loans that enjoy federal government backing. This unique feature means that instead of directly lending the money, the FHA provides insurance to banks and private lenders. This insurance assures them that they will be reimbursed for any losses they might face if the borrower fails to fully repay the loan promptly. For an in-depth understanding of how FHA loans operate, we invite you to explore our comprehensive blog post. FHA 203K Rehab Loan. If you're eyeing a fixer-upper, the FHA 203K Rehab Loan could be your golden ticket. This innovative loan bundles your mortgage with additional funds specifically earmarked for repairs or updates. These updates can range from essential structural repairs to energy-related enhancements. It's important to note that this loan is not designed for financing luxury upgrades such as installing swimming pools or tennis courts. Fixed-rate mortgage. Steadfast and unchanging, fixed-rate mortgages offer a consistent interest rate throughout the loan's duration. These loans are often available in various term lengths, including 10, 15, 20, and 30 years. In the realm of home loans, the 15 and 30-year options reign supreme, comprising approximately 75% of all residential mortgages in the United States, according to mortgageloan.com. Hard money loan. For those looking to borrow without the involvement of traditional lenders, hard money loans present a viable option. These loans are funded based on the property in question, rather than your credit score. They typically come with requirements such as a substantial down payment and a shorter repayment schedule, as per NerdWallet. Homeowners Association, WA. A homeowners association is a private organization responsible for the management of planned communities or condominiums. When you purchase a property governed by an HOA, you agree to adhere to the association's regulations and fulfill your monthly or annual WA dues. Failing to meet these obligations can result in the association filing a lien against the property or even initiating foreclosure proceedings. Home sale contingency. A home sale contingency is a mechanism that allows a buyer to inform the seller that their purchase of the seller's property hinges on the successful closure of the buyer's current property. This contingency is often negotiated through a clause in the contract or an addendum. It's a strategic move, commonly used when a buyer needs to sell their current property to secure the down payment for the new purchase or when they prefer to use the proceeds from their sale rather than their savings for the down payment. It's important to note that, in some markets, a home sale contingency can impact negotiations with the seller. Inspection. An inspection takes place when prospective buyers enlist the services of a licensed professional inspector to visit a property and compile a detailed report regarding its condition and any necessary repairs. Typically, this inspection aligns with the due diligence period, granting buyers the opportunity to comprehensively evaluate whether they wish to purchase a property as is or request the seller to address specific repairs. Inspection contingency. Also referred to as a due diligence contingency, the inspection contingency is a provision occasionally included in a purchase agreement. It provides buyers with a predefined window during the escrow period to conduct essential inspections. Land lease. In the conventional homeownership model, when you purchase a property, you own both the house and the land it stands on. However, some situations involve a land lease, in which you own the home but pay rent to the landowner for the use of the land. Loan contingency. A loan contingency, often called a mortgage contingency, is a clause or addendum within an offer contract. It permits a buyer to withdraw from the deal and retain their deposit if they are unable to secure a mortgage under the specified terms within a fixed time frame. Mortgage pre-approval letter. Acquiring a mortgage pre-approval letter is a crucial step for prospective homebuyers. It offers insight into their affordability by identifying the loan type, terms, and amount they qualify for. This letter is issued by a lender after evaluating the buyer's debt-to-income ratios, available cash, and credit history. In many cases, sellers or their representatives require a mortgage pre-approval letter for any non-cash offers, as it serves as evidence that the buyer has been pre-qualified for financing. Multiple Listing Service, MLS. The Multiple Listing Service, commonly known as the MLS, is a comprehensive database that allows real estate agents and brokers to access and contribute information about properties available for sale in a specific region. When a property is listed for sale, the listing agent records it in the local MLS. Buyers' agents frequently refer to the MLS to explore the current listings and assess the selling prices of similar homes. According to Inman.com, there are over 600 MLS organizations in the United States. Natural Hazards Disclosure, NHD, report. Most states mandate the provision of an NHD report, which discloses whether a property is situated in an area at higher risk of natural hazards. Typically, the seller covers the cost of this report, which is delivered to the buyer during the escrow process. The NHD report encompasses various natural hazard zones, including special flood hazard areas, potential flood areas, high fire hazard severity zones, wildland areas with forest fire risks, earthquake fault zones, and seismic hazard zones. Offer, counteroffer. The real estate transaction unfolds as buyers submit a formal offer for the property they intend to purchase. The offer may match the list price or reflect what both the buyer and their agent consider a fair market value. The buyer's agent formalizes the offer in writing, secures the buyer's signature, and then presents it to the seller's agent. The seller may choose to accept the offer immediately, thereby formalizing the purchase contract, or respond with a counteroffer, marking the commencement of negotiation, documented on paper. Option period. Texas only. In the Lone Star State, there exists a unique concept known as the option period. This period, akin to a due diligence phase, is exclusively available to buyers who opt to purchase this right for a negotiable fee and within a negotiable timeframe. During the option period, Buyers are strongly advised to conduct their inspections and other due diligence activities, although it's not mandatory to do so within this specific timeframe. If, for any reason, the buyer decides to terminate the contract during the option period, the earnest money is promptly returned to them. Pre-approval. Gaining pre-approval is a critical step for prospective homebuyers. It involves completing an application that allows a lender to comprehensively assess their financial situation. This evaluation encompasses factors like the debt-to-income ratio, the ability to repay the loan, and creditworthiness. With this information in hand, the lender furnishes the buyer with a letter specifying the exact loan amount for which they have received pre-approval, as well as the total approved sales price. The letter typically outlines both the estimated down payment and the potential interest rate. Given its thoroughness, a pre-approval letter is often the preferred choice for sellers when reviewing offers. Preliminary report. A preliminary report is a comprehensive document that exposes any title-related issues that the seller must address to deliver a clean and clear title to the buyer. It offers insights into ownership history, existing liens, and easements associated with the property. To compile this report, the title company delves into property records at the county recorder's office. A preliminary report is a prerequisite for a title insurance company to issue a title insurance policy, which most lenders require borrowers to purchase to safeguard their interest in the property. It's customary in many regions for the seller to cover the cost of this policy, although this aspect is open to negotiation. Pre-qualification. Pre-qualification involves a lender's preliminary estimation of the amount a homebuyer is likely to be approved for during the loan application process. It's a swift assessment based solely on the buyer's verbal information, without requiring any concrete evidence or verifications. Principal. The principal balance of a mortgage is the actual amount of money owed to the lender, excluding the interest. For instance, if you borrow $300,000 to purchase a home, that $300,000 represents the principal. Each month, buyers make payments toward both the principal and interest, calculated daily for most loan types. Typically, these payments first go toward covering the interest before gradually reducing the principal balance. After all, the interest component is what motivates the bank to provide the loan. Probate sale. A probate sale unfolds when a homeowner passes away without leaving a will or designating the property's recipient. In such cases, the probate court authorizes an estate attorney or another representative to enlist the services of a real estate agent to sell the property. This process is usually more complex and time-consuming than a conventional sale. Proof of funds. When making an offer, sellers typically require buyers to furnish proof of funds. If you're acquiring a house with a mortgage, this documentation demonstrates your financial capability to cover the down payment and closing costs. In the case of an all-cash purchase, it verifies that you indeed possess the necessary funds. Purchase and Sale Agreement (PSA). A purchase and sale agreement, often referred to as a written contract, serves as the formal agreement between the buyer and seller, delineating the terms of the real property transaction. When a home is under contract, it signifies that the buyer and seller have formally committed to the sale and purchase of the property. Real estate owned, REO. Real estate owned is a designation assigned to properties owned by a lender due to an unsuccessful foreclosure sale at auction. These REO properties can sometimes be acquired at below market prices, as most banks aim to reinvest the proceeds rather than engage in prolonged marketing efforts. However, these properties are usually sold as is, meaning that no repairs will be undertaken, which may pose challenges for financing. Realtor. The terms actively licensed real estate agent and realtor are often used interchangeably, but not every real estate agent holds the title of realtor. A realtor is a member of the National Association of Realtors, NAR, committing to uphold the association's code of ethics. This commitment ensures a high standard of practice and care when serving the public, customers, clients, and fellow members. Rent back. Rent back, or leaseback, is an arrangement where the buyer, now the new homeowner, allows the seller, who has become the tenant, to remain in the house beyond the closing of escrow. The terms of this arrangement are negotiated in advance and typically encompass aspects like a lease deposit, a daily rental rate, and the duration of the lease. Seller concession. Sellers may offer concessions to motivate buyers to purchase their property. Concessions often take the form of contributions toward the buyer's closing costs, subject to certain limitations and approvals by the buyer's lender. This ultimately leaves more money in the buyer's pocket upon completion of the transaction. Seller disclosure. A seller's disclosure is a comprehensive document in which the seller provides information about the property or any factors that could impact a buyer's decision to acquire the property, to the best of their knowledge. It may also include non-property specific aspects that can affect the enjoyment of the property, such as pest issues, property line disputes, knowledge of significant construction projects in the area, and more. Short sale. In a short sale, a property is sold for less than the debt secured by it. Short sales necessitate approval from the seller's lenders, as the proceeds from the sale fall short of the amount owed. The approval process for short sales is often protracted, extending the time required for closure compared to traditional sales. As we conclude our exploration of these indispensable real estate terms, we hope this journey has equipped you with valuable insights into the intricacies of property transactions. The real estate world is rich with knowledge, and understanding these fundamental terms is just the beginning. If you're eager to dive deeper into the realm of real estate investment and want to discover when the perfect time to invest might be, we invite you to click on the video displayed on your screen. There, you'll find expert guidance and invaluable information on seizing opportunities in the dynamic world of real estate. Thank you for joining us, and we look forward to assisting you in your real estate endeavors.